All right, so this is the last inventory cost flow assumption lecture, and so we've done average cost, we've done FIFO, and now we're going to jump into LIFO, and so again we're just going to kind of crank through this. So last in, first out. So last in, first out. Kind of like with first in, first out, we assumed that the first ones indoor inventory, the first items indoor inventory, we're going to do the first items sold out of our inventory. Of course, as the name indicates, under LIFO, we assume that the last ones in our inventory are the first ones out. And, always try to look for illustrations. And in class, I use this. So apologize if it seems a little bit, I don't know, lame or whatever. But I always think of like Taco Bell refried beans, right? So whenever you have Taco Bell, right, obviously they have the vat of refried beans and then they make it in the morning and then, they make a little bit later and they scoop off some as they serve and then they put more on top and then scoop off more and then put more on top and scoop off more. And and so it's just sort of this, wherever they're taking the refried beans, it's always coming right off the top, right? So it's more like a pitcher of water rather than a funnel. And so water goes in and then water gets poured out. The beans go in and the beans go off the top. And so the newest beans are always the ones that are getting sold or ones that are going out the door. And so that's just the assumption of the flow. Now, and so for LIFO, that's essentially the picture we're trying to kind of think through as far as the way the inventory is flowing. We'll kind of talk about, even though the physical flow might not resemble that, why there might be benefits to using that assumption later on in this lecture. But for now, let's just kind of walk through this example. All right, so we're going to be calculating cost of goods sold and any inventory. We're going to start with periodic. And just as a reminder, with the periodic inventory system, we don't touch inventory. We don't calculate cost of goods sold until the end of the month. And so it's just a one-time calculation. And so again, last in, first out, if we're kind of looking at our different layers here. So we have an August 1st layer, August 5th, August 13th, August 24th. We have all these 4 layers. So last in, first out means that the ones from August 24th, we're going to start there as far as the ones we assume are being sold. And then August 1st is the ones that we assume are still on hand. And so we're just trying to figure out which ones are sold, which ones are on hand. Again, August 1st, we sort of work from there when we talk about ending inventory. And August 24th, we're sort of going to view it from there in terms of cost of goods sold. Again, we talked about this a little bit in the FIFO lecture, but I want to highlight it again in the LIFO lecture, is that, theoretically, the way that we should go about solving this is you figure out what's in our ending inventory first. So we're going to start with August 1st, and then we're going to derive cost of goods sold. And so that would be the approach that we want to use. And so in our ending inventory, we know there's 2,340 units. Again, we start with the August 1st layer. Since there are 2,340, of course, that layer, all of that is assumed to be an ending inventory, and then also some from August 5th. And so 2,100 units from the August 1st layer and another 240 units from the August 5th layer, which gets an ending inventory of $21,834. All right, so again, following that theory, once we have that number, or ending inventory number, now we look at our cost of goods sold. And again, we derive that, right? So our total cost of goods available for sale minus our ending inventory, that gives us our cost of goods sold, right? And so again, the math is hopefully fairly straightforward. Our cost of goods sold would be $35,820. And then of course, as we move forward into September, those 2 layers would still be there going forward. So in September, of course, there'd be more purchases in September, sort of think about several additional layers kind of being added on here. And of course, as the sales go, we're going to start scooping off the top. And so again, if we think about this under the periodic system of LIFO, I mean, just kind of think about this. These August 1st units, they might never be touched. In other words, you think about that bottom layer or the oldest layer under LIFO. As long as you keep purchasing more than you're selling, you're never going to touch that layer. And in fact, probably over time, you're going to build up several layers, one on top of another. And so, so it kind of on one level doesn't make sense, right? Because we know that, a company's not going to have inventory from 10 years ago still sitting somewhere physically. But the LIFO system assigns those costs. So we kind of act as if the inventory is that old, even though it's not. And so hopefully you can kind of see that a little bit here, where those layers would start to build up. And again, this is 1 month. You could imagine if you did this for several years. I mean, you could have very old costs sitting on your balance sheet, and just be aware of that. Understand the way the system works, and we'll talk about sort of pluses and minuses of that. All right, so under the perpetual LIFO system, or LIFO cost flow assumption, instead of waiting until the end, we go layer by layer by layer as the sales are being made. So we look at the layers on August 7th, then we'd look at the layers on August 19th, then we'd look at the layers on August 27th, because remember, with each of these sales, you would be recording cost of goods sold. And so we're just going to record cost of goods sold with each sale, knowing that the timing is a little bit different than what we did with the periodic system. All right. So again, when we come to that first transaction, so basically we start with our August 1st, we buy some more inventory on August 5th, nothing's changed, whether it was FIFO or LIFO at this point in time, nothing has changed. But as soon as we have that first sale, that's where things change. And again, we're trying to figure out, okay, what do I include in my cost of goods sold? Because I need to record that transaction as part of this sale. And so with cost of goods sold, we're going to start with that August 5th layer, right? So if we sell 1,420 units, we're going to pull directly from our August 5th layer. So we're going to assume those are going out the door because, again, last in, first out. The August 5th item were the last ones in, so they're the first ones out. But of course, 875 units is not 1,420 units. So we need to also pull from the August 5th layer. And so we're going to pull another 545 units from the August 5th layer, August 1st layer, meaning there's only going to be 1,555 units available in that layer after the August 7th transaction. And so just to be clear, when that August 5th layer, I mean, it's gone. And whenever we adjust the August 1st layer, they're gone. And so hopefully you already see that LIFO, using the perpetual inventory system, is going to give you a different amount of cost of goods sold, which means it's going to give you a different amount of ending inventory compared to periodic. And so unlike FIFO, LIFO is going to be different. And again, it's because of that timing issue. And so now we're just going to move forward. There's another, of course, that balance remains. And then we move forward with that August 13th. Really no transaction here, but we do now have a second inventory layer. And we have the sale on August 19th. And so if you look at this, we have 960. And again, we're going to pull from the August 13th layer first. And there's more units available in that layer than what we actually sold. So we're not going to touch this August 1st layer at all. They're all going to come out of our August 13th layer for a total of 9,408. So now you can see moving forward, we now have 2 layers of inventory under LIFO. We have an August 1st layer and we have an August 13th layer. Next transaction, again, we update everything. Again, the August 13th, there's only 170 left. But we're going to move forward and we have another layer being added from the August 24th purchase. So again, adding another layer. And now we're going to have the sale on August 27th. Again, we're selling 1,250 units. And of course, we know that we're moving from the last in, or we're going to be the first ones out. And so we're going to pull all of those items from the August 24th layer. So there's no need to touch either of the other two. We record that, it's 12,500. And then of course we update our inventory count. And so we have we still have the same 2 layers. And now we have an additional August 24th layer where there's 615 units that remain for a total cost of 22,277. So again, we go from 1,865 units down to 615 units with that sale. Okay, so hopefully that makes sense. So now we come to the end of it. The period's over, and so the cost of goods sold for the period rather than sort of like calculating ending inventory and then getting to cost of goods sold, we've just been tracking it continuously. Now, obviously, if there was a physical count issue, we might do a physical count. Usually with Perpetual, we might do it, once a year or maybe once a quarter. But essentially, what we have here is we're just directly calculating cost of goods sold, and we're calculating any inventory, and we're sort of assuming that there's nothing that's been lost at this point in time. Again, this is different than what we had under the periodic LIFO system. Okay, so kind of comparing the cost flow methods, again, when you look at everything within the periodic, a couple things to kind of highlight here. First of all, LIFO, it reports the highest cost of goods sold, and it reports the lowest ending inventory. FIFO reports the lowest cost of goods sold and the highest ending inventory. And the same thing is true down here. You can see that again, it's the lowest inventory, or sorry, the highest inventory and the lowest cost of goods sold, the highest cost of goods sold, and the lowest inventory. And so again, that's always going to be the case, and the average is always going to be kind of somewhere in the middle. And then the other thing to notice is that across the two systems, the average cost method is different and the LIFO method is different, but within FIFO, they are the same, as we already discussed. And so sort of the highlights here, of course, is that, in this situation, the reason why LIFO is having the highest cost as part of cost of goods sold is because that's where they're carrying the current costs. And if you remember the chart, the costs were going up. If the costs were going down, then LIFO would have the lowest cost of goods sold. But generally speaking, prices go up. And so generally speaking, LIFO is going to have higher costs of goods sold. But again, LIFO carries current costs on the income statement, and FIFO carries current costs on the balance sheet. Again, because the prices are going up, that means the highest costs are going to be on the income statement for LIFO, and the highest costs are going to be on the balance sheet under FIFO. Again, if prices were going down, it would be the opposite. As an additional aside, IFRS does not allow LIFO. Obviously, when we think about those layers building up, it doesn't make a lot of sense as far as just we have this system of accounting where we're recording things that really doesn't reflect reality. And so that's why IFRS does not allow it. It basically is like, this is, doesn't make sense. And honestly, the big benefit, was we'll talk about, is in the US tax code. And so well, let's walk through that next. And so why might you choose one method over another? A lot of times physical flow, should be part of the decision, right? So, if you're at that, that dairy, you're a dairy producer, or you work at a restaurant, if you're at a grocery store, I mean, because things can spoil, obviously there is a very obvious physical flow to your inventory. The first ones that you buy are going to be the first ones that you sell. And so that a lot of times can drive an inventory cost flow assumption, because there's just an obvious physical flow and you want your accounting to reflect that physical flow. But sort of on the other side of that is that income taxes are a big factor here. In that, so if you think about LIFO, you're carrying higher costs on your income statement. So cost of goods sold is higher, which means gross profit is lower. Lower gross profit, operating expenses are all going to be the same. So then when you get to that pre-tax or that taxable income, under LIFO, that taxable income is going to be lower. Gross profit is lower, taxable income is going to be lower, which means you're going to pay less in taxes. And of course, we don't have to use the exact same accounting internally under US GAAP that we use under the Internal Revenue Code. They are different systems, except for this idea of under the IRS has what's called a conformity of inventory treatment. So in other words, whatever they do under US GAAP, they have to have that same treatment under the tax code. And so what it does is it creates an incentive for companies to use LIFO for GAAP so that they can use it for taxes to lower their tax burden. And so that's probably the most important factor as far as what determines LIFO, because the majority of companies in the US do use LIFO. All right, so again, back to this question, why would companies choose LIFO? Again, we're trying to minimize taxes, taking advantage of being able to increase your cost of goods sold. If they weren't concerned about taxes, then what system might make a little more sense? Well, in this case, The one that's probably going to make a little more sense is FIFO because it's going to report higher net income. And generally speaking, companies prefer higher rather than lower net income. And so a lot of times they're going to choose FIFO if taxes really aren't their main concern. All right. So as far as LIFO reserves, different professors cover this at different levels. For the purpose of my class, I'm going to go through this in a lot of detail, but just as a reminder, the way I test on this really more is, first of all, do you know what kind of account LIFO reserve is? It's a contra asset. That's going to be the one thing I'm going to ask. And then really the other thing is, okay, based on a scenario, did the balance go up or did it go down? And if it went up, is it a debit or a credit? And if it went down, is it a debit or a credit? You're not going to do like a painstaking, multi-step calculation. But I'm going to do that here on the lecture more as a way for learning, not necessarily as preparing you for the test. And so what do we got going on here? What does LIFO reserves mean? So basically, there are some companies that might use FIFO or average cost for internal purposes, but they might use LIFO for external. In other words, for taxes and things like that. So obviously with LIFO, one reason you might use FIFO internally is it's a little bit less costly, a little easier to do. As we saw with FIFO, it's fairly straightforward. And also, you could actually have contracts that require you use a different system. And then obviously there are certain things that might be priced like on a cost plus basis or something like that. And so you might want to have those, different, you might want to treat costs differently. So all that to say, you have this thing called the LIFO reserve account. When there is a difference internally versus externally, when this account shows up. There's the account is a contra asset. It's a LIFO reserve account, and it is the difference between the internal method and LIFO. So it's like, if you kind of imagine, what we're doing is we're calculating an inventory balance. And so for FIFO, we're carrying those current costs, probably higher costs, on our balance sheet. And so the LIFO reserve then is the difference between that higher cost under FIFO and the lower balance sheet cost under LIFO. Again, the focus here is on the balance sheet, not on cost of goods sold. The focus is the difference on the balance sheet. And essentially what it does is it creates an adjusting entry where it's going to take costs from the balance sheet and shift them to the income statement for external purposes. But internally, you're going to still use your system that you are already using. All right, so in our example, they use FIFO for internal reporting purposes, but LIFO for external. They have monthly adjusting entries. And so under FIFO, internally, again, they track ending inventory as 11,300 in January, 12,200 in February, and 12,000 in March. Under FIFO, we just have COGS 85,000, kind of keeping it simple. And then when we started the period, the balance in the reserve account was $100. And again, it's a contra asset, which means that is a credit balance. Now, what they're saying is, okay, under LIFO, our inventory balance, again, the focus on the balance sheet here, the inventory balance would have been less. In other words, in January, it would have been 10.8, in February, it would have been 12, and in March, it would have been 11.6. So every single month under LIFO, the inventory balance would have been lower if we had used that for internal purposes as well. But again, that's very normal for that to be the case. So what do we do in terms of this adjusting entry so that our internal books get shifted to the way we want to report things externally? All right. And so how would we go about doing that? So first of all, we're going to look at January. And so in January, the LIFO reserve balance is the FIFO balance in our inventory account minus the LIFO balance in our inventory account, which means the balance in our LIFO reserve should be a $500, and just to be clear here, a $500 credit balance. And so for the journal entry amount, we have to compare the new balance, $500 credit, to the prior balance of a $100 credit balance. And so looking at that difference, we need to credit our LIFO reserve account. So we credit our LIFO reserve, right? So it's a contra asset, and that rolls into an adjustment to our cost of goods sold. So we're not changing our inventory account, but we are changing our cost of goods sold. So just to be very, very clear, we're not touching our inventory, but we want our cost of goods sold to reflect LIFO. And so that's essentially what we've just done. So we've forced cost of goods sold to reflect LIFO, higher cost of goods sold. So then in February, same idea. Again, this is the FIFO inventory, what we actually use. If we had been using LIFO, this would have been the inventory account balance. So there's a $200 credit balance to our LIFO reserve account. Comparing that to the prior balance of $500, we need a $300 debit entry to our LIFO reserve account. And so we would debit LIFO reserve, which means it's going to credit cost of goods sold. Again, we're shifting cost into basically forcing cost of goods sold to reflect LIFO. And the last one, March, the balance was $400. Hopefully it's pretty easy by now. Obviously that's a $200 increase, which means we need to credit the LIFO reserve, which would be offset by a debit to our cost of goods sold. Again, the whole idea here is that now our cost of goods sold reflects LIFO, but our balance sheet reflects FIFO in the inventory account. But the inventory account with the LIFO reserve is a LIFO asset balance. It's just in two different accounts. And so each month, we're kind of thinking about, okay, now what happens to cost of goods sold? So in January, cost of goods sold is going to be higher because of the adjusting entry. In February, it's going to be a little bit lower because of the adjusting entry. And then in March, it's going to be higher because of the adjusting entry. All right, so the other LIFO topic we're going to talk about here in this lecture is what's called a LIFO liquidation. And so one thing we wanted to talk about, we kind of started to talk about was, that vat of refried beans or water pitcher, whatever you want to say, is that when you keep piling these layers, like layer upon layer upon layer upon layer upon layer, you can have some very old costs sitting there in that, in that vat or whatever that is. I mean, you could have inventory from years and years and years ago. And basically, as long as your purchases keep outpacing or are fairly similar to your sales, those layers just kind of sit there. And so with a LIFO liquidation, that's a situation where that doesn't happen, where your sales outpace your purchases, and basically you have a large decline in your physical inventory balance. And so that's called a LIFO liquidation. And so we need to kind of understand what happens when you have a LIFO liquidation. This is going to be similar to the LIFO reserve, where I'm going to go through some calculations and really show you how the math works. But really, for the test, I'm more concerned that you just understand the concept. Like, okay, what's the issue going on with the LIFO liquidation? Why does it occur? What's the impact on the financial statements? How might investors deal with that? All right. So the idea here is, what are the effects? And so the issue is that your gross profit, again, you have very old costs sitting there, which means your cost of goods sold is going to be very low in that period because you're using very old inventory costs, which presumably are much lower than the more recent inventory costs. So your gross profit is going to be way higher and your net income is going to be way higher. And so from an investor's perspective, it does become a bit unclear, like, what is driving those higher margins? Is it that you're just more profitable? What happened? And so that can be misleading for investors. And so we need to kind of navigate that and understand how exactly mechanically, at least I'm going to show you mechanically how that happens, but I'm more concerned that you understand the concept. And so we have the following purchases. Notice we have several different years. We have a beginning balance in 2024. And basically what I did, I kind of created this situation where, prices are going up, but we have some, pretty old costs sitting on our balance sheet, right? So prices are generally going up, but really that's a pretty big jump between our beginning balance and the purchases we made in 2024. So those could be from several years ago. And then in every year, if we look at our 2024 purchases, we sold a little bit less than we bought. And in 2025, we did the same thing. But now in 2026, we only had $10,000 in purchases, but we sold 13,200 units. And so this is a situation where there's a LIFO liquidation, right? So there's a very, basically you're just blazing through these layers that you had built over a number of years. And so anyway, so we're going to kind of walk through and kind of see what happens to our financial statements when we do that. All right, so in 2024, hopefully fairly straightforward. Our COGS is our 11,300 units. So again, last in, first out. So if we think about what existed, we had 3,000 in beginning inventory and then 12,000 of new purchases. If we only sell 11,800, we're never going to touch that January 1st layer. Everything's coming out of the 2024 purchases. And so the cost of goods sold is going to be $14 a unit for everything. And so at that time, their gross profit percentage is 24.32%. And so at the end of that, now I'm not gonna update this table. We're just gonna kind of hang out and just sort of, this is more like what you might do on a different kind of a problem where you can't animate slides. But at that, we do now have two layers. So we have 3,000 units at $10 a layer, and now we have 200 units at 14, because of course, out of this 12,000, we sold 11,800, so 200 of these remain, right? So that is the number of layers now going into 2025. And so in 2025, again, we're selling fewer items than we purchased. And so all the sales are going to come out of that 2025 layer. So our cost of goods sold for that year is going to be 190,000. We take that as a percentage of our sales, and we can see that our gross profit percentage is about the same, 25%. And now our ending inventory is going to have three layers. So we're going to have 3,000 units like we did before, the 200 units we had before, and now an additional 300 units at $15 per unit. And so you can see that now we have 3,500 units sitting there in our inventory. And then 2027 or 2026 happens. It's a little bit different now, right? Because in 2026, we sold 3,200 units more than what we purchased, meaning that all of the 2026 layer is going to be sold. All of the 2025 layer is going to be sold. All of the 2024 layer is going to be sold. Again, remember, there's 200 in this layer, 300 in this layer. And so you're going to now go all the way through that and even into our beginning layer. And so you can see we're selling all of the new layer, all of the 2025 layer, all of the 2024 layer, and a good chunk of our beginning layer. But notice that much lower cost of a good portion of those sales is at $10 per unit. You know, that's what is it, like 25% of the sales? Well, not quite, but a pretty good percentage. And so the cost of goods sold, if we add all that up, is $189,300, which means the gross profit is 31.71%. Now, you might not think that's a big deal, but going from 25% gross profit to almost 32% gross profit, I mean, that's crazy good. I mean, the markets would react to that. I mean, the CEO, you know, that would be a very substantial increase, because, you know, a 7% increase on 25% margins, I mean, that's pretty big. I mean, that's like a 30%. It's a large increase to our gross profit. But we can see the reason why is because we liquidated a bunch of old inventory costs. Now, I want to be very clear. We didn't liquidate old inventory. We liquidated old inventory costs, because under LIFO, remember, it's not changing the physical flow. It's just we're keeping those old costs on the books. And so this LIFO liquidation, it's an accounting thing. It's not like, oh, we finally got rid of that inventory from 10 years ago. The inventory is probably still from last year, but it's just a matter of the way we had accounted for it. And so it creates this fictitious increase in our gross margin. And so that's the issue. That's the underlying issue with the LIFO liquidation. And so after all said and done, we're really short on inventory. There's only 300 units left. It's still at $10 a unit, but basically now next year in 2027, we're going to start new layers. But just be aware that, again, the impact of that LIFO liquidation can be quite substantial. And hopefully this helped you understand that a little bit more.